The housing market's definitely shifted. How's that going to affect you? Well, let's take a look. Hi, I'm Nick with the Iannitti Group, coming at you with a real quick housing update for the month of October. Thought I'd start right here from Jason Loris with Parcel. In the absence of trustworthy, up-to-date information, real estate decisions are increasingly being driven by fear, uncertainty, and doubt. These decisions can be hugely consequential for consumers and businesses. Absolutely true. There's a lot of sensational, news headlines, things like that, and when you see those, you really got to dig into that data. You got to look at that report. You got to see what's going on. You can't just, kind of glance it and think that you know what's going on, because you might actually miss an opportunity, right? We know now, as I record this, rates are about 7%. Sam Cater, Freddie Mac basically said, look, there's a lot of uncertainty and volatility in the financial markets, which are heavily impacting mortgages. And as a result, we've seen the 30-year fixed rate mortgage essentially double in a single year. That's huge, right? But we need to keep in mind, what is the Fed actually trying to do with these interest rates rising, right? Well, we all know they're trying to get inflation under control. But when you think about it kind of in layman's terms, what they're trying to do is they're trying to bring the cost of goods and services down, right? Well, in respects to homes, they are succeeding, right? Odetta Cushi, chief economist over First American, said the aim of the Fed tightening is to curtail demand in an effort to tame inflation. When it comes to the housing market, the Fed's actions are working, right? We've basically seen home sales, both existing and new, are falling. Builders are pulling back on production. That's a key thing to remember. And the annual house price growth has definitely declined from the peak here in early March. Okay, and we're going to see a continued decline here through Q3 and probably through Q4. Okay, so Georgia Tui said, hey, basically, even a couple months ago, 7% rates seemed unthinkable. And at the current pace, we can expect them to surpass that level in the next 3 months. The Fed has already come out and said that they're going to basically raise rates in November or December. The problem is some costs of goods have come down, right? We've seen that, like especially in the housing market. However, core inflation remains incredibly stubborn. And some experts are saying basically that's due to the service related industry and the fact that many of these employers have had to pay more for labor, right? So these prices are not necessarily coming down. So we're going to continue to see some rate hikes, right? I thought this was incredibly smart though, right? Think about this. There's no doubt that increasing mortgage rates are going to make home buying more challenging or essentially less affordable, right? However, buyers may still find opportunities because right now there's a reduced buyer pool, right? There's reduced buyer demand, so that means there could be more opportunity for a buyer. However, this is coupled with the fact that these changes coincide with the time of year when buyers have historically found the best market conditions to obtain more bargaining power, right? So what that means is as we come into Q4 into the holidays, typically there are less buyers now. We know the buyers that exist are more serious. However, this could be kind of a double whammy for opportunity for buyers. So keep that in mind, okay? Mark Fleming, First American, basically came out and said, while mortgage rates are expected to continue to drift higher over the coming months, much of the rapid increase in rates is likely behind us. That's probably true. Nationally, while month-over-month house prices may decline, annual house prices are not expected to do so. Keep in mind that's nationally, not individual markets. I'm going to talk about that here in a little bit more, right? So what's ahead? Well, the KPMG CEO outlook basically came out. They said, they're most of all they're optimistic for the next 3 years. However, the majority of them think we are going to have some type of recession here in the next 12 months. And if we do, it's going to be mild or short. In my opinion, we're already in this recession. But what do we know about recession? I've done numerous videos that prove that recession is not directly correlated to home prices. However, we do know that mortgage rates typically fall during a recession. So this could be a reprieve for the buyers here next year, right? If we do hit a recession, rates are likely to come down. Also keep in mind in 2024, that's a presidential election year. You could bet the powers that be are going to do whatever they can to kind of cook the books and make sure the economy appears to be as strong as possible heading into that election, okay? But keep in mind, this is crucial, okay? Again, back to Mark Fleming. When the economic uncertainty dust settles, the buyers and sellers who are on the sidelines will jump back into the housing game. Demographic trends support elevated purchase demand in the years to come. So it's a question of when, not if, for the housing market. So keep this in mind, right? We have the second largest population, that being millennials, and they're kind of split between older millennials and young millennials because there's a wide gap there. But these young millennials are now becoming home buyers, right? They're reaching that age essentially, and that's going to happen for years to come. Keep in mind, we have not built homes over the last decade. We've got about a 5 million home shortage. And I just told you that home builders right now are starting to pull back on building again. That's not going to help. I think one of the biggest problems is when we talk about these millennial buyers coming in, they have no real historical reference on rates. All they've ever known are incredibly historically low rates around 3%. And now that these rates have doubled, they're like, what? Their affordability is evaporating, and they can't quite get their head around it, right? Older people know, hey, rates back in the 90s were 9, 10%. My parents, when they bought their first home, I think their rate was like 14%, right? So it's kind of to be expected. It's not the end of the world. However, to a younger buyer who has no real frame of reference, they still have not gotten their head around that because the changes has occurred so rapidly in such a short amount of time. I think as people realize if these rates persist over the next couple of years, we're going to see those buyers coming back regardless because they're still going to need a place to live, right? So what does that mean? That means for the bearish folks eagerly awaiting home price crash, you're probably going to have to keep waiting, right? As much as demand is pulling back, supply is as well reducing downward pressure on prices in the short run, right? So we've already seen this. We saw inventory increasing over a couple of months, and now we've seen it kind of plateau, and it's still not anywhere we need where we need it to be, right? So no one's really calling for a crash or a bubble or anything like that, right? So what's ahead for home prices? Well, as I said, obviously the root cause is always, almost always supply and demand. This is what is currently going on with our supply and demand. It's inverse from what we've seen over the past few years during the pandemic. We've now seen showings rapidly reduce, right? Because of the affordability of mortgages, and we've seen active listings increase, right? And even though I've told you this is kind of plateaued out, keep in mind, we went from like a half a month worth of inventory to now like a month and a half worth of inventory. We still need 6 months of inventory for a balanced market. Okay. So we've got this, this overriding interest rate issue, which is kind of suppressing this buyer demand. As soon as that changes, we're going to see some of that demand change as well. But keep in mind, if you think we're headed for a crash, remember in the last crash, we had 5 consecutive years of home price depreciation. No one is calling for that right now. Right, most of our appreciation now, when you look at this is Mortgage Bankers Association Home Price Expectation Survey, which is a combination of economists nationwide, National Association of Realtors. They're all calling for appreciation next year, while Fannie Mae and Ivy Zelman are calling for depreciation. We average that out, and it kind of comes to a flat market. Okay, looking at the Home Price Expectation Survey, when you're looking at all these analysts, all these economists across the country, the vast majority of them are calling for appreciation next year, right? Some of them are calling for depreciation, okay? And they actually took that survey out in the next few years, and you see the overall number of people that are going to be calling for appreciation. Even Wells Fargo said, look, we're probably looking at a dip next year around 5%, but then 2024, things are going to rebound, okay? But I thought this was the most important thing to look at. Zillow recently did a appreciation depreciation forecast, right? And they looked at the MSAs, right? MSA is a metropolitan service area. Think of that as like a city or a region. Basically, they think 618 of these MSAs are going to have appreciation next year. However, 257 of them are going to have depreciation, right? There are going to be some markets out there that are going to be negatively affected, that are going to see some type of correction, typically the most overheated markets, right? But I think this is also important to keep in mind. The vast majority of them say that correction is probably somewhere not larger than 3%, right? So if you've owned your home here for a few years, you've had 18% roughly appreciation year over year for the past few years. If you have a 3% correction here next year, is that really the end of the world? No, not really. Does that mean that it's probably not the best time to sell your home? No, it doesn't. If that suits your life needs and everything else, are you going to get the price that you would have got 3 months ago? No, probably not. Are you going to get more than you did last year? Yeah, you still are, right? We still do see buyer demand out there. Right now, I have a listing right now in Linda Vista in San Diego. We've received multiple offers on the property. We've had over 30 showings. So places that are cute, that are staged and marketed correctly and priced correctly, location's pretty good. We're still seeing some buyer demand there. So keep that in mind, okay? If you have questions about what these numbers mean for you, if you're wondering what's going on in your neighborhood, I would tell you keep your eye out for my local market update. I'm going to do that here pretty quickly, but that's it. Thanks so much for tuning in. Remember, who you choose to negotiate for you absolutely matters.